Ladies and gentlemen, good day or good evening, wherever you may be. Thank you for taking the time to be with us today. My name is Khaitan and I'm a partner in Khaitan's corporate M&A practice group. I would like to extend a warm welcome to this webinar to every one of you, whether you are in the audience in India or abroad. This is the third webinar in our M&A Masters series over the course of 2021. We've been thrilled with the tremendous response we have received to the M&A Masters series, with literally thousands of people taking up our invitation to register to attend the series not only from India but also abroad and view the webinar recordings. We're also very grateful for the interest and support which our clients, associates, and others have shown in registering for this webinar. On this slide is the agenda for today's webinar, or rather the order of events. In short, today's format will be a discussion between our expert panel, followed by a Q&A session with audience questions. We have already received several audience questions, and if you do have questions, please submit them using the facility provided in the webinar portal. If we cannot cover all questions during the webinar, we will respond offline by email after the webinar. Also, please note that a copy of the presentation and recording of this webinar will be sent to you after the webinar. The second webinar in the M&A Master Series dealt with buyer due diligence. In this third webinar, we will explore why and how sellers should do M&A due diligence. We chose seller due diligence as the theme for this webinar because seller due diligence is an important process by which sellers can expedite and facilitate M&A transactions and achieve optimum pricing and deal outcomes. Also, in the past, some sellers have not appreciated, as they could today, the importance of seller due diligence in preparing for what they have for sale and presenting it to buyers in a user-friendly manner. This webinar is focused on the sell side only, as we have dealt with the buy side in our last webinar. Our aim in this webinar is to give you an insider's view of due diligence from a seller's perspective. This brings me to our expert panel. Every person who has registered for this webinar today has already received an email with full particulars of the credentials of our panel, so I will not spend any time repeating or summarizing their experience. Suffice to say, they are all M&A experts with excellent M&A credentials. We are fortunate today to have three leading M&A practitioners on our panel, namely Divya Murthy is Vice President Corporate Legal and M&A of Reliance Industries Limited. Anshul Gupta is Managing Director and Head of M&A for Citigroup Global Markets India. Bimal Modi is a Partner and Head of M&A Transactions of Deloitte India. In addition, we are joined by my fellow Khaitan & Co. corporate M&A partners Ganesh Prasad and Prasanjit Chakravarti, who are both very experienced M&A lawyers. So now let us bring in our expert panel members. So I'll start with Divya. This is a question for you. I think the slides we can take off. Why should sellers, Divya, be concerned about doing due diligence? Let's start with you.
Hi, Hagrid. Thanks for having me on the panel. It's an absolute pleasure to be here with all of you virtually. So this I guess, Hagrid, as we are all aware, the whole construct of diligence came from this principle of caveat emptor, which is a buyer beware. So traditionally, it was always the buyer who had to do diligence, who had to look at all the information, do fact finding, understand the business of the seller, and so on. And I think over time, as the M&A process has evolved, people realized that there's a lot of inefficiency in the process when there was only a buyer doing diligence and identifying things as they went along the process. And the seller would then be on the back foot reacting to those situations. I think that's where this whole construct of a seller diligence has come in. In my own experience, I think in the last 7-8 years, across most transactions we have done on the sell side, we have made sure we've done a diligence beforehand, and it has served multiple purposes. I think the first one is to get the target sale ready. So once we do diligence, we actually have already identified structuring related issues. We have identified key deal breakers, key red flags, etc. And what this helps us do is actually either address the issue upfront in terms of resolution, or find mechanics to actually give a context to the issue and present it in an appropriate fashion to a buyer or the bidders. Thirdly, it will also help us strategize solutions. Now, this solution may just be we need to disclose so that we are not open for liability, but still we have strategized and discussed it internally before going to a bid. So that definitely helps the process. I'll give you an example of a transaction we were doing where we were on the buy side. And I guess the seller hadn't done such a great job of diligence or had not done a diligence. And we actually identified multiple liability concerns. And when we started the transaction, when we halfway through diligence, we raised this with the seller. And they said, okay, fine, we'll restructure the transaction from a share sale to an asset sale. This had multiple consequences. Firstly, it delayed the entire diligence process. We changed the focus of our diligence. We became really wary because if the seller doesn't know these kind of liabilities exist, then God knows what else will crop up. That also meant we did more diligence. We asked for more protection in documents. We started chipping away at price. We put value adjustment provisions in the contract. So it just goes downhill a little bit from there, from a seller perspective. So that's one thing. The other thing when you do diligence is it brings in a lot of efficiency and structure to the process. You have basically a structured, defined way in which you're sharing information. Buyers will not feel asymmetry in what they're getting, that they are posing questions and they may not get stuff. So that helps the process. They also get to the issue or red flag stage much faster than they would if they were just doing fact finding. So what happens is instead of a fact finding diligence, they do a confirmatory diligence. So both from a perspective of a buyer comfort and a seller efficiency and timelines, it really helps. And I think the other most important thing with diligence does is it gets you fully prepared for what happens during the course of transaction and post-transaction in terms of maybe CPs, conditions precedents, conditions subsequent, process. So I'll give an example. We did one transaction where we're moving some assets or a business out of a company into another. And we figured that certain IT assets could not be transferred because they were essential for the existing business. So we actually went about figuring out what IT asset support would be required, where we would need to get third-party consents. Now, all of that meant that we had a good plan in place which you could provide to the buyer. And that meant the buyer thinks that there is a structured and thought process that's gone behind the whole process. There is seamless transfer to them. And therefore, the value add happens and valuation is held. So I think all of these things reflect why it's essential that the seller due diligence be better prepared and address the buyer's concern in that fashion.
That is really insightful, Divya. I think the importance of seller due diligence is completely sort of known now. So turning to you, Anshul, how should we define seller due diligence, and what should be some of the common work streams and sector issues that arise?
Thanks, I agree. Well, let me take that. And thanks, Divya. I think that's a good segue. So maybe, I think as Divya mentioned, I would say the seller due diligence, while a large part of it is aimed at providing and facilitating buyer due diligence, and therefore preparing reports that facilitate buyer due diligence. A second category, and I'll give you some examples, could also be where sellers do due diligence for their own internal decision-making process as well. And that second part could become equally important in certain situations. When it comes to buyer due diligence, I think some of the common work streams that we have seen in our practice uh, belong to categories such as commercial due diligence, legal due diligence, uh, financial, which is both accounting and tax related due diligence. And then there is a lot of sector specific requirements. So for manufacturing or industries which have potential environment related concerns, for example, you would also conduct as part of seller due diligence EHS survey or report, which is environment, health and safety. Similarly, if there is a manufacturing industry, uh, many times you would also conduct a technical due diligence, and that would entail hiring a technical experts to look at the plants, at some of the equipments, and coming up with their analysis on how good the plant is, what is the capital expense required going forward, is it enough to sustain the business for the next few years, so things like that. And then there will be also certain sectors which require very specific diligence. So, for example, if there are transactions which might be in the real estate sector, a lot of due diligence or diligence reports will focus on, again, depending on commercial real estate or the nature of real estate, on the leases, contracts, on the value of the underlying lease real estate. Likewise, if it's a financial sector or an NBFC, there'll be a due diligence report on the loan book because that becomes the most important criteria for uh, for a buyer to conduct due diligence of an NBFC type asset. Just to give a few other examples, if we did a tower transaction where a lot of the due diligence pertain to evaluating the what's called as the MSA or the master service agreement between the tower operator and the various tenants, which is the telco operators. So that requires a sort of sector specific diligence report. So I think there are various types of these diligence reports in those broad buckets I described. And maybe I can also give an example of where sellers might do some due diligence for their own decision making. And that decision making could pertain to various things. Some of them could be linked to valuation, for example, and we'll cover that a little bit further as we go along. It could also be linked to getting some strategic insights. So we had an example where we were working on the sell side, and as part of the sell side, one of the due diligence scope for our sell side, the due diligence provider in this case, on the commercial side, was to try and estimate what are the key synergy areas for some of the key potential buyers, and actually go ahead and estimate some of the synergies. In this case, it was a very a deal focused on strategic buyers, and a large part of the value, while there was a standalone value, but there was a significant portion of the value which was from the synergy value, which would be created jointly from the two businesses together. So our client, our seller, wanted to have a sense for which specific buyer will have what kind of synergies, so that later on when they get to negotiations, they could have their own assessment on how to leverage this knowledge, and also to decide which buyers to take forward in the process, for example, right? The ones with the most synergies would have presumably the most ability to pay. So those are some of the examples where it could be used strategically, not just for purposes of sharing buyer reports, but even for internal purposes.
It's really fascinating to see how the practice has changed and how deep an exercise this is. And more and more transactions of seeing this. I recall, having started as an M.A. lawyer maybe 2.5 decades ago. there was absolutely no concept of seller diligence. And it was really only a buyer diligence, and seller diligence or vendor diligence was unheard of as a concept. And that really leads me to this question for you, Bimal, that how is seller diligence different from buyer diligence in terms of the purpose and objectives?
Yeah, I think, thank you, Haigreve. And I think a lot of the benefits of seller due diligence are already articulated well by Divya and Anshul. But just to add to some of the comments they made is that the seller due diligence, it's first a starting point also for an independent view of the business. Prospective buyers do know of the business through their own management meetings, have read the IM, and this actually will give them and supplement the story and what they've heard about the business and through discussions. A seller due diligence can actually validate some of the assertions or some of the ideas that have been presented to them during the course of their interactions or early interactions with the company and the bankers. Absolutely, in terms of the seller due diligence, the scoping is very, very important. We must bear in mind that this is actually initiated by the seller. So very important that the seller thinks about the entire transaction perimeter and scopes it adequately, because some of the benefits of the seller due diligence will be negated, right, if we are not making it fit for purpose. So once we have identified the investor community, be it strategics, private equity, what they are looking for, so the objective of the transaction and who we are reaching out to needs to be met by the seller due diligence, right? Very often I've seen where the companies don't have a full perspective. They want to either cut costs, they don't want to incur too much time, they want to speed it up, keep it high level, all of that. That will negate all the benefits that we've just talked about, right? And the idea is that the seller due diligence will speed up process, right? Time is of the essence. The whole reason why we wanted a seller due diligence is because we can go to multiple bidders, we can send them a diligence which is ready, done by an independent service provider, covers the various aspects as we talked about, HR, IT, finance, legal, ESG, and they'll quickly be able to look at the company and get a good sense of the company, look at the business issues, accounting issues, and the various other issues I mentioned, and take a call, right? Yes, top-up diligence happens, but this is a very good base, right, to start making the decision, right? A go, no go, and then quickly you can eliminate investors and then focus on and time with people that you are most likely to succeed and conclude a transaction. So absolutely, seller due diligence has lots of advantages if utilized well compared to a buyer due diligence. It is initiated by the seller, done by firms like us, lawyers, accountants. It's an independent view, right? It's still not a kind of a seller's view. It is an independent view, which eventually the reports get signed off to prospective buyers. So it's not kind of meant for only sellers, it's actually for the buyers, right? So there is a level of independence in these reports as well. So I would just like to conclude to say that, if done rightly and in the right scope, right fashion, covers the right aspects, it will help with everything, negotiation, timelines, deal breakers not coming up at the last minute, and value preservation. Last point I'll also say is seller due diligence help a lot with companies who've never gone through a process, right? I've seen very often companies going first time for raising money or M&A and never done a due diligence. They themselves are struggling with the kind of data. Audits are very different from due diligences. So it gives them also a good view of their current practices, the current issues in the business. So if well utilized, it's not only about just getting an investor, it's actually getting to know your company from an independent expert also.
That's really useful, Bimal, what you said. And it reminded me of one of the transactions when, we had a very hard time convincing the promoter to do actually a vendor diligence. And ultimately, we did convince, the promoter. We commenced on the diligence. And what came out of the diligence was that the promoter's family house was actually owned by the public company he was trying to sell. And he'd completely forgotten about it. And that's when he really thanked us profusely to say that, look, I would have carried on with this process and gone ahead miles without even thinking about this separation fee transaction. So I think you summarized it exceedingly well, that it's not just from a buyer's perspective, but it's really, it helps the seller and the company as well. So moving to you, Prasanjit, who should be on the seller's due diligence team? Can you show some light?
Well, I think, thank you, Hegri. The seller due diligence team should comprise of both the internal team of the target company as well as external consultants. That's often the very first crucial step which I think the target needs to take, is to get a team in order, the right team. Insofar as internal team is concerned, it's advisable, and what we've seen in practice, the CEOs, the KMPs, the general counsel who know the ins and outs of the business and who can actually help collate and coordinate other department heads to get the relevant information ready for them as well as the external consultants. It's very critical they are entrenched in this whole process. Second of all is the external bit. I think we have, of course, our fellow panelists shedding light that we need lawyers, accountants, tax advisors, experts, as Anshul was elucidating that there could be environmental diligence for a manufacturing company. It's just not good enough to say, well, they have a Air Act and Water Act license. You need to come up with contamination-related issues if there is one. At least in the report, it should come that you have thought through that issues properly. You need sectoral experts also coming in if there are complicated sectoral issues like defense. You need to have people who understand offset or other sectors. You can't just have general practitioners advising on those matters. So blend of both, that's the first and foremost. The scope should be very clear to them. And one should be very careful that the perception here should not be that it's a captive team which has done the diligence, because then it really doesn't carry much credibility. You must have independent, reputed people, specialists doing this exercise. I can give you two live examples. Same story, but different sides of the coin and how it panned out. There was one transaction where the promoter had some litigations going on in one group company, and that was doing the rounds in media. Unfortunately, we were acting for the investor side. The promoter in their vendor report had not a single word mentioned about that episode. And that really gave a lot of jitters to our client, that why would somebody brush this under the carpet? And in contrast, you can guess what happened to that deal though. We didn't move forward. In contrast, in one more deal, what happened, the vendor were upfront that, look, these are the issues out in media. This has nothing to do with us. We will remove this company which is tainted from this transaction structure. And they were very, very upfront about it. They got a reputed, I would say, entity to do the ABC diligence, anti-corruption diligence. And it was a far more seamless conversation. It's often perception which matters. If you are shoddy in your report, the impression it gets to the buyer is that, look, you don't kind of run your business in a streamlined fashion. So get your team and get to them, do them a very, very good job. I think the other example I can think of very quickly is the management, because once the management is involved in the vendor due diligence process, they get well and truly prepared for the Q&A. In every transaction, buyers at some point through their advisors will grill the promoters, right, or the management team, test what they have said, and if the promoter or the management team is unprepared or look under, that looks that not so good for the promoter or the management. It looks kind of orchestrated, artificial. They don't know what's going on. It doesn't inspire confidence. So I think these two examples clearly, in my view, have indicated that you must get the management involved properly and really get horses for courses, the right set of advisors involved, and make sure that it's a thorough job and be as transparent as possible.
So that's a really extensive exercise for a seller due diligence, and it's obvious that It needs considerable investment of time and money as well if you really want to do a proper seller's diligence. So coming over to you, Ganesh, on that topic, can you shed some light on how do you plan a seller's due diligence?
Well, thank you, Mike. I think a lot of it has been actually mentioned by the rest of the panelists here, but I can possibly look at sharing a couple of anecdotes which we have possibly come across. See, I think primarily when you're planning any kind of a seller due diligence, you need to keep the scope of the due diligence in mind. You need to look at who is the what is the end result that you're really achieving. I guess some of it was touched by Anshul and Vimal too. Now the question is it a strategic guy who's sort of investing into the company? Is it a minority investor who's coming into the company? And that makes a huge difference when you are sort of planning and making your decisions there. And then I think fast forward, you possibly will also have to have some kind of a plan, depending on in terms of you have a roadmap, I would possibly say, and there has to be a sense of urgency because most of these things, the planning happens immediately. You get a call sometime around last week of December, and they want to close before 31st March, and then it's a large company, and neither the general counsel sleeps, not the lawyers sleep, and not the accountants sleep. The only people who sleep there are the promoters of both these organizations. We don't have lights, so that's okay. The problem is then it starts with that, and then you realize that okay, the new year is the only day that you have taken off, and this has happened, and you start the process. You have a particular timeline, and very strict timelines where you sort of make it's really strict timelines that you run the process. And if it is a large company, and I can tell you this with experience, our largest e-commerce deal which we had here in the space, they have a whole host of subsidiaries, and for some reason, invariably they would not sort of, and there is a trend, and you do not touch the mothership, you sort of put everything underneath in the SPV. Now, the gestation period of the person who is sort of doing that deal is usually 2 to 3 years, and nobody knows where the documents are after the 4th year, and it happens in a number of cases. I can tell you in a couple of instances, we sold the other larger one which we both had done last year. There were about 40 subsidiaries, and this went back to 60 years back. Nobody knew where the RBI filings were, and eventually it was a mess because 60 years is a fairly long time, and what is the shareholding pattern, and if you're looking at the resident, non-resident, transfer of shares, are you really looking at how is the structure going to work? A fair bit of planning goes there. I think with a mindset that you have the end in sight, I guess it is very important that seller due diligence is always planned fairly well, and in the larger role, you also end up cleaning a lot of your house, which is possibly the best thing which happens, because then you're not really reinventing the wheel when you're looking at making the disclosures, basically.
Thank you, Ganesh.
If I may just add to what you're saying, I think I can't agree more that planning is extremely important, and I would say planning and scoping. But for planning, because otherwise you lose time, you scramble later on. So again, to give another example, the most often as bankers, one debate we have with promoters and clients is, do you really need an industry report or not? Most people understand legal report, accounting due diligence report. There's always a debate on industry report. And that really depends on who the buyers are, right? And that's a conversation which bankers with other advisors provide, that if the sense is that large audience is going to be private equity buyers, in most instances, you're better off having an industry report. If it is largely an in-market strategic buyer, they know the industry, they don't need that. If it can be a mix, there's always a question of, okay, if we have it, what is the scope? So I think all of these things will become very important as part of the upfront planning.
Thank you. Actually, Ganesh and spoke about the planning, and Anshul very rightly sort of supplemented. But I think then Anshul mentioned about scoping being very important. So maybe Bimal, if you can really show us, how to scope seller's due diligence sensibly to ensure that it is efficient and cost effective. So how do you define the scope?
Absolutely, I agree. I think scoping is the most important thing. If time and effort is not spent in getting the scope right, the whole purpose of the due diligence will be negated. It will not worth the paper that the reports are written on, right? And we spend maximum amount of time, debating, articulating on the scope, right? And I'll give you some examples. And what I mean is when you're drafting the scope, it's essential to firstly start with thinking about what's the transaction perimeter, right? What are we trying to achieve? Second, who is the buyer or what is the buyer universe, right? Anshul just mentioned about, is it a corporate, strategic, private equity? Then you bring in the company-specific, industry-specific issues, right? And once you combine all of that, you'll be able to potentially define a scope which will be fit for purpose, as we call it, right? The scope has to serve the end result. So things like, what are the areas you want to cover, right? What period of coverage you want to go back to? What are the industry issues? So I'll give you examples. If it's a heavy manufacturing site, do you want to bring in an ESG specialist upfront? So any issues on the ESG front are properly articulated. If there's an industry which is heavy on manpower, resources, people, right? And dependent on people, you want to do an HR due diligence upfront and make it part of the scoping, right? Likewise, if it's an industry which is not, or a business which is not well understood by the buyer universe, and you want to tell your story and back it up, a commercial due diligence or an industry report, right, of that industry should be presented upfront. It'll save a lot of time, effort, later on. And we spend maximum time convincing some of our clients, promoters, etc., that cost is, yes, very important and you have to manage the cost, but at the same time, don't sacrifice the whole purpose and objective, right, by just focusing on the cost. Things where you can certainly save money are things like you don't want to do tax due diligence for all your entities on day one, where you've taken a view that there are not many issues. Certain jurisdictions we can cover later on, right? Okay. But don't sort of start scrimping the scope and cutting it down. Make it very high level, right? Don't cover adequate periods, right? Typically you would say 3 years, good track record is important in a due diligence, right? Don't cut that down. Have good materiality thresholds, right? Don't sort of start, making it kind of very, very 30,000 feet up, right? And then the buyer will look at it and say, actually, you know what? You've not even peeled the 2 levels of the onions, right? Forget about getting to the issues. So I would just reemphasize and say scoping is important. Time spent earlier on. Check your scope. Get it. If you have the opportunity, get the bankers involved. Get potential investors if you've already identified. Get them involved. Make sure that it's fully, covers all the aspects and the requirements of the scope. So even the buyer diligence, right, is limited, right, and it covers all the key issues. So we tend to always, even focus on industry because there are very specific industry issues which don't get captured. Very often, people send standard scopes, right, and scopes which are kind of, yeah, fine, this is a full scope, get on with it. But actually, the nuances of the industry need to be factored in. And obviously, the issues of the business, right? Obviously, you will know that if it's going to be a strategic, as I said, right, is our synergies is our best sell, right? So do we want to focus on OPEX do we want to focus on? There are group-related, entities. So there are group cost allocations coming in. We need to, articulate and take them out and, show them very clearly in our report. So point net is scoping is absolutely important. Make sure you spend a good amount of time upfront on scoping.
Thank you, Bimal. You mentioned about business diligence and risks. So moving to you, Anshul, just to take that business risks part. How do you identify, define, and use key business risks and opportunities to shape and scope the diligence?
Sure. When we talk about the business diligence or commercial diligence, maybe I'll answer that by giving a few examples. And maybe two examples I'd like to pick. One is example of just something which is so-called a sunrise industry. So there'll be an industry which is not yet well understood, and you are marketing a target or a company which is in that space, and there are very little existing data points, precedents to go by, right? So in that case, it is dimensioning that business opportunity sector itself that becomes very important. And we are seeing that increasingly. I think we are in the middle of a pretty significant digital disruption in India and globally for that matter. So a lot of concepts may be a little bit more advanced and better understood in Western world, and in Indian context, they may still be at a nascent or early stage. In those situations in particular, you need to bring out that business opportunity piece quite clearly, and that's where a commercial or a business diligence could be handy. So examples of these sectors could be transactions related to electric vehicles or electrification. So that is a very complicated topic by itself, and not many people understand it. So just to delve that into a further. So when you talk about EV, it has multiple sub-linked points. So starting with, it's a fundamental shift of technology from what is the traditional, call it lead acid batteries, to a lithium-ion battery pack. So what does the technology entail? What does the supply chain look like? Are there enough suppliers? Is there enough infrastructure in place? And then most importantly, what is the economics of that switch? Is it at parity to what is currently being used? So all of that work can be done upfront by sellers. Need of expert, and this requires some kind of expertise to really dimension that why this opportunity is really a huge opportunity going forward. And then within that, there could be elements of competitive analysis. So once you establish it's a great opportunity, what is the competitive landscape like? Who are the different players? What is our company doing differently? What are its unique competitive advantages, which would then be used as selling points, even by the bankers like ourselves in our information memorandum. So many times we would draw upon those on the back of industry report or the business opportunity analysis. On the risk side, there is a counter example could be in industries which are considered sunset industries. So there, the bigger question for buyers would be, is there enough room left for this industry? What is the threat of disruption going forward? And it's important to dimension that to give comfort, because many times, just like people underestimate sometimes opportunity for new sunrise sectors, we've also seen in practice the general human tendencies to also overestimate the risk of disruption. And therefore, it's important to establish that balance with proper data and logical analysis, which can be very helpful through a business. And there are numerous examples of industries getting disrupted today, be it the entire cash economy, cash in circulation, the ATM market. As I described, if EV are going to come, obvious disruption is to the traditional auto sector, the lead acid-based sectors. So I think becomes a very, and I think going forward, this will be even more important because a lot of such issues will come in number of transactions.
Very interesting, actually. And, great observation that as businesses and sectors are getting more and more complex, I guess putting these and doing the work in advance as part of vendor diligence can actually change perspective of a prospective buyer, because certain opportunities which he hasn't seen can suddenly come into light because of a great sort of vendor diligence report. That's really useful. So moving to another subject, Ganesh, over to you. Let's talk about disclosures. So why is seller disclosure important, and how should sellers use disclosures to protect their interests in M&A transactions?
So I think, of course, disclosures effectively are, it's your first level of insurance when you're sort of making disclosures to your standard reps and warranties and, indemnities. So I think at some level, it is a value-sensitive information which is being made. It's qualifying what the reps are stating, and I think it is it's sort of at some level is your first level of insurance, which is there, because now, of course, as transactions have progressed, we have, and I think over the last 10 years, seen 10, 15 years, I would possibly say, the R&W insurance, you have, R&D insurance for tax, you have insurance for business reps, you have, many other things which have sort of, many other products which have actually come up in the market, at least from the Indian market, I can possibly say. But I think the first port from a seller's perspective is that your first insurance is always being the disclosure that you are really making, because that effectively means that you're taking fraud out of the window. The knowledge is basically put, at the end of the day, you put all the facts on the table, and eventually it's the decision of the acquirer or the buyer to sort of take a call. Now, whether that sort of culminates into a specific indemnity on certain matters, that's again a business call. But I think those disclosures are definitely will definitely help. One of the things which I think we also sort of see is even in the whole process, there are certain times that businesses view certain things differently. Now, I can tell you in the new age segment itself, if you look at a couple of businesses, they say, listen, the e-commerce policy is not applicable to us, because we don't look at us as ourselves as a marketplace, but we look at ourselves as a service provider. And we respect the view, not a problem. But unfortunately, the Indian regulators, they sort of like to make it a little difficult for everyone, and it's a lawyer's delight. There is nothing black and white; it's always gray. So you're welcome to take the best position for your company, and it could be, even from an accounting perspective, whether you are sort of like recorded that as something which is a payable, it is not. It depends. Of course, so many factors are there now, and basis that we see businesses sort of when they're selling, especially from a seller's perspective, it sort of helps to achieve these, keep these things in mind, and especially if this is something a little sensitive, and to drive that process in the way that we want. So that is effectively where the disclosure leads to.
Thank you. I think Divya also started with the concept of caveat emptor or buyer being aware. So very useful. Let's move to another topic in relation to vendor diligences. And Anshul, dealing with businesses, how do you think sellers protect themselves against giving confidential information in due diligence to buyers who are or might become, competitors of the seller, or who might otherwise use the information to the detriment of the seller? How do you deal with such situations?
Sure, thanks, Agri. I think that's a very, very debated topic in most of our transactions. And as you rightly pointed out, the concerns that the sellers have could be multifold. One could be uh, in any process, eventually there is either one or zero buyer. And in both situations, they are concerned. If it is no buyer, they are concerned that their competitive info is out there with a bunch of buyers, and they're continuing to run the business going forward, and having to deal with additional competitive information out there in the market. Uh, Even if there is one buyer, and this is especially true in, let's say, minority deals, there could still be other competitors or potential competitors uh, who have that information which could be strategically used against. That could even include financial sponsors of private equity, because I've seen examples where some of our clients are concerned that, well, with all this information, what if this private equity firm takes this intelligence and all the work away and goes and invests into my competitor and starts using it against us? So there are various ways and means to do that. Of course, the most common tool is a non-disclosure agreement or a confidentiality agreement, and that is usually a very heavily negotiated document, as I'm sure you would have done several of these at Khaitan. I think there can be various nuances to it. What is the tenure? What are the implications? How tight the NDAs have been, and I've seen NDAs getting sometimes being negotiated for as long as 3 weeks if it is very onerous as viewed by the buyers. So that's one tool, but often clients say that, look, NDA is a piece of paper, I don't trust it. In practice, you're still using information, or based on information, if you have derived certain of your own work, you can still use it. Can't use my information. So that challenge always remains, and you have to balance between right disclosure and the right outcome. But some of the other tools we've used is one, a delayed disclosure. So by that I mean you go through the process first round, you save the most competitive, most sensitive information right till the very end. And I've even seen situations where you have negotiated everything down to last comma and dot in the SPA, except showing one last piece of very sensitive information to a buyer, final buyer, a day before signing the deal. So that could be the other extreme of, but that obviously applies only to extremely important information and which may not have a valuation impact, or at least the sellers think it should not have a valuation impact. The other way to deal with this also could be a physical data room. So the risk with online data room, even with all the technology out there, you can protect read rights, print rights, download rights, but still people worry that nothing stops you on putting it on your screen, taking snapshots from your camera and saving it, right? And NDA or no NDA. So for some of the very confidential documents, sometimes we have used a physical data room where it's only kept, of course, in a COVID environment, it's quite challenging, but I'm talking about pre-COVID, where you keep it in a physical location, and there have been instances where we have very strict rules around that. So we only allow third parties, only as, let's say, a lawyers or a independent advisor can come and visit that room only between 9 a.m. and 2 p.m., only have X number of people, so all kinds of rules around it, and then they go away. They cannot take anything, they cannot copy, they cannot take photos, and they have to form their own report off of that source material, but the principal buyer or the principals don't see that information. I would just add one last comment. Sometimes this might even be required in a competitive or a CCI type situation. Sometimes even CCI will require these kind of procedures and ask the buyers and the sellers to form what's called as a clean team. And in addition to an NDA, sign a clean team agreement or a CTA, which basically defines that who within the buyer's team can be part of that clean team. And only that clean team can have access to certain sections. So in those instances, we have done data rooms where certain data room sections are open to all, but there will be some folders or pieces of information which are only accessible to the clean team members who have signed. And this would usually be things like any pricing related information which could be sensitive from competition standpoint are not viewed by members of the buyer's team who are involved in pricing decisions, for example. So that's another way people protect their information as well.
Just to add to what Anshul said, earlier there used to be only NDAs which you would sign between organizations, and you would put in an obligation that the organization ensures its employees maintain confidentiality. Increasingly over the last couple of years, you actually insist that individuals from the other side also sign up to those documents, as in you get a specific undertaking from each individual, because that also is a deterrent for the individual. No individual wants to be sued in their own right, correct? So that also places additional kind of a moral check, so to speak, on that.
The really insightful, Anshul and Divya. So, Divya, I'll put the next question to you. Having been part of so many sort of buy-side, sales-side M&A transactions, can you tell us how diligence reporting in a seller's due diligence is different from buyer's diligence? How to strike a balance, between too much, too less?
Sure. So I think I agree. Both Bimal and Anshul had previously discussed this whole thing about scoping and purpose of the diligence. And the moment you look at diligence reporting from that perspective, so a buyer's report is more to do with fact finding, determining issues. A seller's reporting, what you would look for your advisors to do is to give you context for the facts, and then also help you mitigate risks, give you solutions, and so on and so forth. So that's essentially the difference between a buyer's report and a seller's diligence report. But also the form of report is takes different forms, in the sense they have this construct of a full-blown report where you expect everything under the sun to be put into the report. It could run into reams and reams of. And then you also have these red flags report, which is only key highlights or key issues which are done. But increasingly, at least in my practice, we do something which is called a hybrid report, because you don't expect management to read 500 pages of information on what the company has been doing. You want to give them an overview, and yet at the same time also give them the key issues so that they are comfortable enough to go and do the management presentation and meet the buyers. So that's the kind of reporting we do. The other two important aspects to keep in mind is, when do issues get flagged off? You don't want to go through a 2-month diligence process and suddenly a lawyer, the firm coming back and saying, here there are 30, 40 issues, and now deal with it. Because that's when you want to go to the buyer and start the discussion, right? So you would expect, as your advisors, the mandate would be that as issues crop up, keep highlighting, keep giving solutions, keep having discussions so that we're solving things along the way and not right at the end. And the last thing to think about is, to whom does that report cater? So if you're also looking to share that report with the buyer, then the form of that report will change. I think this was also touched upon previously by Vimal and Anshu. That what you would end up doing is having a more independent, unbiased report. Like Sanjeev mentioned, you'll ensure you have external advisors so that it gives credibility to that report. So those are the kind of nuances you look at when you're doing that reporting, and that's how you'll strike the balance between too much or too less.
I like your hybrid concept, and as you are always very innovative in getting the best out. So, PC, moving to you. I know we are going to run out of time, but before we take audience questions, one for you and then for Bimal. Can you share, PC, what are some of the potential solutions for problems identified in seller diligence? We've discussed all the reports and all. Now, the problems are there. How do we resolve them?
Well, I think, mean, there's no, shall we say, one size fit all. It's eventually the nature of the problem, the gravity of the problem, which will dictate what solution is appropriate. Having said that, I think let's start off with 3 buckets of issues. One is, your ministerial issues, housekeeping issues, secretarial issues. Not important? Not really. I would say please fix them, definitely. Anyways, one should not run your business in gross negligence or non-compliance with laws. It gives a terrible impression to any buyer that you can't even maintain proper secretarial standards. So please fix them as a part of your vendor diligence outcome. Do fix them. It hardly entails cost. Even if it entails cost, it's a cost well spent. Second are major issues, pricing issues, structural issues. Now, these are issues which needs a more serious, detailed, prolonged discussion. And remember, just to put this in context, in one transaction, and this will be a very common example for most of you who are dealing with M&M. There was a large customer contract, in fact, few of them, which had a clause which basically says any change in shareholding will need their prior consent. In our case, the company was looking to get a 20% stakeholder, not a change in control. We did the vendor diligence. We made a strong recommendation to the promoter that, look, these key customer contracts are coming up for renewal. Why don't you go to them, modify some of the terms, including get a carve out for inter-group reorganization, and consent should only be required in case of change in control. And guess me, they got their approval. Now, in contrast, we were coming from our experience in one other transaction. When we went to the customer after the investor was already in talks with us, it was in distress, we were held to ransom. The customer decided to strong arm us, decided to tweak the commercial terms to their advantage, knowing very well that now if they hold up the show, the deal is struck. So a significant feature of vendor diligence is when you get solutions from lawyers preemptively and proactively and not reactively, take actions. Yes, it will entail cost, but eventually, even if you don't take action right now, when the investor comes into the picture, you still will have to call the same customer, but you will have to do the same action item under the glare and glaze of the investor to their satisfaction. So that's a big advantage, I would say, which we saw, that you take action preemptively and don't wait for things to go out of control. One more example is, value additive things. I remember many transaction trademarks which are critical to the business are not registered. If you register them, it makes your business looks better, clean, enhances your value, and that's what you want as a seller, isn't it? A clean house up for sale. So please get those steps out of the way. Of course, I do understand. I mean, there have been examples where a significant cost is associated, which only makes sense if a buyer is willing to do the deal. And then you wait for the definitive agreements to be executed, because then the buyer has skin in the game, there's a binding commitment, and you have break fee and those kind of construct built it so that if the buyer takes you for a ride, you can claw back some of the costs to incur. But at least you are mindful of what is to be taken. Last point is restructuring. If you have issues, regarding assets, let's say a disputed title, you are not blank. You know what is to be done. You can do a asset sale. You can demerge that asset which is not good for your asset portfolio, and if you have no solution really, at least you can be upfront about it with the buyer and propose either a reps and warranty insurance package or indemnity or holdback kind of mechanisms. All it does is enables transparent, candid discussion with the buyer, which is a big enabling tool in M&M transaction. Thank you.
Very useful indeed, Prasanjit. We'll take a last question and we'll request you, Bimal, before we get to a few audience questions. We have lots of questions from the audience. We've looked at, sellers' diligence, and from the seller's perspective, can you share with us how do buyers use the results of the seller's diligence to their advantage?
Yes, no, I think very much so. And as we discussed earlier, the purpose, the objectives, the scoping, and all of that. If the seller's due diligence report is properly done, properly scoped, and fully encompassing, the buyers use it for multiple ways. One is obviously get up to speed on the business very quickly. It helps them validate their hypothesis, their whole idea of why they are doing the deal, gets them up to speed on some of the key issues, so that they can decide whether to proceed or not to proceed very quickly. Also helps them understand the valuation and start thinking about what the valuation in their head is, and making a view. They may decide to do a top up, right, depending on what angle they are coming from. If it's, as I said before, if they're kind of a very strategic, they may want to do some more work in specific areas. If it's private equity, they may want to do some other areas like cash flows, working capital, financing needs, all of that kind of things. So there may be an element of top up, but again, sometimes it's kind of just to add on to the scope of what has already been covered or specific areas. Sometimes it's the process. Some companies board requires an independent due diligence also to be done, or ICs require it. So there might be a top up. You should not be, you should be ready for that. And I think the most important thing the buyers use it for is to make a quick decision, right? And that helps the entire process, because you don't want too many buyers hanging around. Then you can decide, as Anshul mentioned, about confidential information, who you share, what you share afterwards with, get to a smaller group of investors. So buyers are very happy with, actually very happy that vendor diligence reports are done. It saves them money, if nothing else, right? Because all the money is currently being spent by the sellers, right? So it really helps the process. They can look at more deals, right? The flow can be improved. So I think the purpose of a good seller due diligence report is numerous, and it seriously helps the buyers in taking a quick decision, if nothing else, and getting up to speed in the business.
Thank you. So I'll take a few audience questions, very interesting questions. We have a host of them, but maybe we'll take a few and then respond to the rest later. So the one question, how relevant is the importance of financial due diligence related to the financial capacity of the buyer and the mode of financing the transaction? The same issue would also be very relevant where a portion of the equity component post-transaction would continue to remain with the buyer. This question comes from Jimmy Spencer from Chemtex. Maybe Anshul, you might want to take it.
Sure, thanks, Aggie. I think that's a very important aspect of diligence, and particularly in transactions where there is a financing element involved. The banks who are financing the buyer for that particular transaction will all require the diligence reports. In fact, what they would require is the seller's due diligence report, but on top of that, the buyers and buyers advisors validation of those findings. And those includes particularly things around what are the cash flow based on buyer's assessment and buyer's advisor's assessment. What is the going forward cash flow profile? What are the key covenants? What are the key ratios, financial ratios that a bank could then go and take into their committees? And I think that's also links back to what Bimal around how buyers use the diligence reports. In these situations, the financing banks actually cannot and do not rely on seller side due diligence. They would rely on buyers and buyers advisors top up or other such due diligence, because they are financing the buyer in this case. So for all debt financing, I think this becomes very important. And similarly on the equity side, I think all of these aspects are basically relevant for preservation of equity, the remaining equity, also what could be the dividend and buyback profile of the business, because that's how it's used to service both the debt provider and the equity providers, and therefore what could be their IRR or returns on that basis. So I think all of these are the fundamental pieces of these sets of analysis.
Thank you. I think another question, maybe for you, Bimal, is really capital gains tax implications resulting out of the transaction for the seller. How relevant is it from a diligence perspective to determine this and address it?
Sure. I think from obviously this is from a buyer's perspective, and the buyer and each buyer's individual situation will vary, right? So this is not from a seller's perspective, but often tax considerations of the buyer are done by their own buyer advisors and depending on their own situation. But one thing I'd just like to add from a seller's perspective, it's important to understand, and very often large part of discussions is the tax consequences in a due diligence, right? And if there are, let's say, for example, tax losses in a business, how are we going to position this? So I know I'm not answering the question directly in terms of capital gains from a buyer's perspective, but that's a very simple answer, right? That has to be objectively dealt with from a buyer's perspective. You can't cover in a seller due diligence. But one area that probably we didn't address before and tax related is to understand the tax consequences. Potentially to the company, the seller itself, and any benefits that can be passed on to the buyers. So it's not only capital gains, but also there might be tax losses and things like that, which the buyer can benefit from a transaction. And typical debates, I think I agree with you and also may have been part of, is the withholding tax in transactions, right? It's, what happens to the withholding tax from a buyer's perspective rather than more on capital gains, is more the withholding tax when they're doing transactions and coming through various different jurisdictions.
Thank you. We have several very deep and interesting questions. Divya, I'll put the next one to you. How should a listed seller company deal with sharing information selectively with buyer parties when there are rules of stock exchanges on UPSI? Can you throw some light on this?
Yeah, definitely. This issue has cropped up a number of times in some of the transactions we have done, and I think part of it is also the revision to the PIT rules, because of which you actually take specific undertakings, you take specific data. I remember a couple of transactions where we had done, and post the transaction we had queries coming from stock exchanges saying what is the level of disclosure that's happened, what is the date the disclosure started, and the stock exchanges expect you to keep a record of a number of details of individuals to whom information has been given, their details, etc. And this has even more relevance when you seek similar information from a foreign party who's doing the diligence. So as a listed company, you need to keep track of when and where and to whom information has been given. You need to inform the bidders and kind of limit. When you give information, you will also need to make it public at a certain stage just before you do the transaction. So you have to be mindful of that. And you need to keep track of everything that is being shared at all points in time and to whom. When there are foreign parties doing the transaction, very often they may not be comfortable sharing a lot of information with you. So you need to put certain obligations on the bidders to make sure that at least they have track of information which can then be passed on if you're required to share it with the stock exchanges. So that's something that needs to be kept in mind.
No, thank you very much. I think then there is a view from the audience that seller's due diligence is meant really for his own benefit and has no credibility or relevance to the buyer. How does one actually make it credible for the buyer? So maybe Ganesh, you want to take this? How to make it credible for a buyer?
Yeah, at some level, I wouldn't disagree with that. Whoever has asked that is possibly asked the right question. See, because when the seller is actually in control of the process, there is a assumption, I would possibly say, that he is possibly pushing certain positions that he has taken vis-a-vis the business to be sort of the position to be taken by the advisors who have been appointed for the purpose of the transaction. Now, it is not the question of credibility, but when you're looking at the sale overarching, then I think you're really looking at what is it that holistically, both from a buyer and a seller perspective, you are looking at. Now, if you were to look, if let's say for, what comes to my mind, if there are, let's say, some tax issues. Now, two different firms, two different organizations, two different people have actually come together. They've possibly taken the same view, and that has helped, rather than sort of, take completely diversely opposite views. But I think somewhere there, the culmination of the reports definitely helps, and it is not without credibility. But yes, there is scope where we also see in certain transactions that more often than not, there will be that particular gentle nudge by the promoters or the CFO or whatever, that this is the position. Why don't you look at it? And they'll give you some. The justification is fine. Eventually, it's an independent decision, which has to be taken by the advisors there. But that is with these two reports, you really have a better case than one report. That's really what it is.
Thank you. I think we're coming to the end of our session, and before we end, Prasenjit, can I ask you to give us 3 key takeaways from today's webinar that you think that the audience should focus on while doing seller due diligence?
Well, I think, again, lots of incredibly invaluable points by my esteemed fellow panelists. I think pick 3 of them is a gross injustice in many ways. But I think I would say, instead of getting micro, I will focus on macro. The first point I would say is the commercials, isn't it? I mean, ultimately, universally, every seller wants to expeditiously sell the asset at the best possible price and lowest possible risk. All of them can be achieved through a robustly done seller due diligence, which the previous question which Ganesh answered is kind of avoid suspicion and carry out independent experts to add credibility to the report. The second is your planning. We have several of my panelists have spoken about the scoping, the planning. It's the scoping and planning which will really get the relevant teams involved in the seller due diligence to focus to understand what is the objective which is being sought to be achieved. And they can all kind of pull their energies, concentrate their energies towards achieving the common objective. And third is outcome. There are several outcomes to be achieved through a properly run seller due diligence. Firstly, dressing up the bride. Yes, when you dress up a bride for a wedding, you don't do a shoddy job. You want to dress it up as well as possible, which means taking care of all wrinkles, straightening them out, dividing all the issues, ironing them out as early as possible during the vendor diligence process as a vendor identified. Second is, if there are red flags, think about structural issues. How can you react to them? Can you tackle them through a structural change? Can you tackle them through a mitigant measure like insurance? Can you tackle them through a demerger? But then setting up the data room for the buyer, because buyer will not take everything the seller provides on face value. It will cross-examine the report and contents. So how will you set up the data room? How much will you share? What is the form of the report, as we have mentioned? Is it a hybrid report or too much of details or just superficial report? I think hybrid report serves you better. And then eventually, of course, the disclosure which Ganesh mentioned, that eventually all this vendor diligence sets up the management very well to disclose qualified threats and warranties in the investment agreement. And that really sets up very nicely the company and the target. Having said that, one size will never fit all, as is more often the case. And what is important is to understand the target. Spend some time. People, like Divya, who are miles ahead, when it comes to diligence, they will be 5 steps ahead of the lawyers. And therefore, you will have to catch up with them. There are promoters who are not that well versed, and that's not a criticism, because they don't do M&A deals. So they need some higher level of handholding, and you have to be cautious. But don't shy away from flagging an issue, because ultimately the objective of vendor diligence is not to mislead the buyer, is to clean up the house, get your house in order, enhance the value, dress up the bride, and put it before the target and the buyer rather, so the buyer can then derive the comfort and go ahead and consummate a deal. Over to you, Hargreaves. Thank you very much.
Thank you, Prasanjit, for your most insightful summary. So before closing, I would like to ask each of you in the audience to respond to the poll slide on your screen to provide your feedback on today's webinar. We take this very seriously as part of our continuous improvement program. Finally, I would like to thank each of our guests for sharing their experiences and expertise with us today. Divya, Anshul, and Bimal, thank you very much. Without you, this webinar would not have been possible. You each did an outstanding job, and for that, we are very much indebted to you. To our audience, I hope you found the webinar interesting and a worthwhile investment of your time. We certainly enjoyed bringing it to you. After the webinar, we will be sending you a copy of today's presentation materials and a link to the webinar recording. You will also separately receive a request for your feedback on the webinar. Please do take time to send us your feedback, comments, criticism, and even compliments. The form takes less than a minute to complete. Please do not hesitate to contact us regarding any matters arising from this webinar. Our contact information is on the contact slide at the end of this webinar. Thank you for the audience today, and we look forward to being of service again at future webinars. Thank you.
Thank you.
For moderating. Highly lovely.